Every year, whether you're a Berkshire Hathaway shareholder or not, investors from all around the world anticipate the Oracle of Omaha's wisdom. Over the weekend, the annual shareholder letter was released, and these are my top 5 takeaways. Hey there, my name is Steven Spicer, and it's my goal to help you invest smarter. And what better way to do that than by learning from the master? There was one thing, however, that Buffett implied that I didn't really agree with. I'll just put that into a separate video, so be sure to subscribe and hit that notification bell so that you don't miss it. And real quick, if you're a fan of videos like this, where we can learn from wisdom distilled from the greats, take a second right now and hit that like button. Let me and YouTube know that you appreciate the work that goes into these videos. Without further ado, let's get to it. The first big lesson came from his warning about screwy accounting practices commonly used by many corporations. I think there's a valuable lesson to be learned here from the point Buffett is trying to make, but I also want to come at this from the other side as well, provide you with an alternate perspective. Here's what Buffett said. After talking about how much money Berkshire's subsidiaries made last year, he explained, "When we say earned, moreover, we are describing what remains after all income taxes, interest payments, managerial compensation, whether cash or stock-based, restructuring expenses, depreciation, amortization, and home office overhead." That brand of earnings is a far cry from that frequently touted by Wall Street bankers and corporate CEOs. Too often, their presentations feature adjusted EBITDA, a measure that redefines earnings to exclude a variety of all too real costs. For example, managements sometimes assert that their company's stock-based compensation shouldn't be counted as an expense. What else could it be? A gift from shareholders? And restructuring expenses? Well, maybe last year's rearrangement won't occur, but restructurings of one sort or another are common in business. Berkshire has gone down that road dozens of times, and our shareholders have always borne the costs of doing so. Abraham Lincoln once posed the question, if you call a dog's tail a leg, how many legs does it have? And then answered his own query, 4, because calling a tail a leg doesn't make it one. Abe would have felt lonely on Wall Street. It's really easy to get sucked into the numbers that managements feed you, or analysts. If you're not aware of this fact that Buffett details, if you just take what they tell you at face value, you can get burned. So Buffett's warning is appropriate and timely for anyone trying to invest smarter. So be aware of that. But if you're trying to compare a company to its peers, then you'll be best served if you can get it as close as possible to an apples-to-apples comparison. To this end, an adjusted figure can be entirely practical and extremely helpful. If you'd like more information on EBITDA, how to calculate it, what it means, I have a video that I'll link to in the description. But as a simple example of what I'm talking about here, as Buffett mentions, companies have different restructuring expenses from year to year. And yes, although those will absolutely come up again and should be accounted for by you as the potential investor, they're not coming up in the same year or even to the same degree for every single company inside a peer group. Meaning if you don't factor them out for the sake of deriving a comparable company analysis, your end result will be skewed toward whichever company didn't incur those expenses in that given year. It'll be inaccurate, wrong. Just because the one incurred the higher capital expenditure this particular year, that doesn't mean it necessarily deserves a lower valuation today as a result. I hope that makes sense. To have a fair comparison, one upon which you could make an educated investment decision, the companies need to be on the same level. Any expense like those would need to be factored out to make this possible. And you should note, that might even require you doing your own adjusted calculations. You shouldn't assume that each company in a particular industry structures that figure, the one they report as their adjusted EBITDA, in the exact same way. And then, if you still really like the stock after that comparison, if it does seem to be relatively undervalued, then heed Buffett's counsel and consider those additional expenses, because as he said, they are indeed very real expenses that will ultimately be borne by the shareholder, potentially you. My second big takeaway from the letter is how serious Buffett is about repurchasing Berkshire shares. It's kind of exciting. He said, It is likely that over time, Berkshire will be a significant repurchaser of its shares. Transactions that will take place at prices above book value but below our estimate of intrinsic value. Clear enough. But that was just the first time of several that he mentions or alludes to this happening in the future. And obviously, with the news last year about them changing the way the process works for Berkshire, we already had an idea that this was coming, that this is coming. But this letter really drives it home. Aside from the mentions, he took the time to express caution with the way it would be done, referencing the carelessness with which many corporations use buybacks to boost share price. On top of that, he gave a couple of very detailed examples of how this has worked in his favor in the past. Warming shareholders up to the idea. He talked about how in the late 70s, they originally purchased enough Geico shares to own 1/3 of the company, and how over time that third grew to 1/2 without Berkshire spending a dime. You guessed it, it was through the magic of Geico buying back its own shares. He provides another example with American Express. He explains, all of our major holdings enjoy excellent economics, and most use a portion of their retained earnings to repurchase their shares. We very much like that. If Charlie and I think an investee's stock is underpriced, we rejoice when management employs some of its earnings to increase Berkshire's ownership percentage. Here's one example. Berkshire holdings of American Express have remained unchanged over the past 8 years. Meanwhile, our ownership increased from 12.6% to 17.9% because of repurchases made by the company. Last year, Berkshire's portion of the $6.9 billion earned by American Express was $1.2 billion, about 96% of the $1.3 billion we paid for our stake in the company. When earnings increase and shares outstanding decrease, owners, over time, usually do well. Some great lessons in there about the proper way for management and shareholders to view buybacks, and something to definitely look forward to in the future. The third big lesson / takeaway is one that particularly resonated with me. Part of my modus operandi is to help people invest smarter, to help them be prepared no matter what happens. Most investors aren't invested this way. They aren't even psychologically prepared for something to happen that maybe hasn't ever happened before. In fact, most investment advisors, most professionals fall short from this perspective. It's one of the main reasons that I left my industry career years ago. It's one of the driving themes of my book, Stop Investing Like They Tell You, that you should be prepared come what may. And although Buffett and I might do that differently, it's refreshing to hear him acknowledge this reality that so many stock and bond only advocates and experts conveniently ignore. He captures the sentiment in his observations about the future possibilities for Berkshire's insurance subsidiaries when he says, "A major catastrophe that will dwarf Hurricanes Katrina and Michael will occur, perhaps tomorrow, perhaps many decades from now. The big one may come from a traditional source such as a hurricane or earthquake, or it may be a total surprise involving, say, a cyber attack having disastrous consequences beyond anything insurers now contemplate. When such a mega catastrophe strikes, we will get our share of the losses, and they will be big, very big." Buffett is acknowledging the reality that some catastrophe that has never before been experienced, whether it's tomorrow or decades from now, that it will happen. And he's prepared. After explaining the specifics of how Berkshire is prepared with its significant portfolio of cash equivalents, he emphasizes, "Berkshire will forever remain a financial fortress. In managing, I will make expensive mistakes of commission, and will also miss many opportunities, some of which should have been obvious to me. At times our stock will tumble as investors flee from equities, but I will never risk getting caught short of cash." I want to give you one final thought of Buffett's on the subject. Just as Nassim Taleb does in his inspiring book, Fooled by Randomness, in this part of the letter, Buffett draws the comparison to Russian roulette, which you should keep in mind because I'll be referencing it again in the next video about where I disagree with Buffett. He explains, "We use debt sparingly. Many managers, it should be noted, will disagree with this policy, arguing that significant debt juices the returns for equity owners. And these more venturesome CEOs will be right most of the time. At rare and unpredictable intervals, however, credit vanishes and debt becomes financially fatal. A Russian roulette equation usually win, occasionally die, may make financial sense for someone who gets a piece of the company's upside but does not share in its downside. But that strategy would be madness for Berkshire. Rational people don't risk what they have and need for what they don't have and don't need. I think that's awesome. I can't tell you what will happen or exactly when it might happen because it'll be unexpected and very well may have never happened before. But I'll be prepared as best I can for it, and I hope to be able to help you as well. It's so good to get that vibe from the man himself as well. The fourth lesson is one that you might find heartening or discouraging. It's when Buffett said, "Prices are sky high for businesses possessing decent long-term prospects." So for all of you struggling to find the next steal of a company, keep that in mind. Buffett is struggling too. There aren't always deals. And when you have strict standards like he does, the standards that have helped him achieve the success he's had, when the market in general is elevated like this, you just come up empty-handed. It happens. And that brings to mind an important point. If you haven't been investing for very long, you should really take special note of Buffett's observation and remember that your gauge for, your experience with valuing companies is limited to the time that you've been doing it. That's true for everyone, but in this case, according to Buffett, you're doing it during a time when it's just very difficult to find a good company on sale. It's surely not as often as you see or hear hyped around all the time. Something may seem fair or undervalued by today's standards, but that doesn't tell you the complete story. You need a broader perspective, like what Buffett has with most of his 88 years on this earth being spent actively studying companies. So be patient. It's okay. Don't lower your standards. You're not just collecting a ticker symbol with the hopes that there'll be some greater fool to buy it from you at a higher price in the future. That's not investing. Buffett explains, "Charlie and I do not view the $172.8 billion detailed above as a collection of ticker symbols, a financial dalliance to be terminated because of downgrades by the street, expected Federal Reserve actions, possible political developments forecast by economists, or whatever else might be the subject du jour. What we see in our holdings, rather, is an assembly of companies that we partly own that on a weighted basis are earning about 20% on their net tangible equity capital required to run their businesses. These companies also earn their profits without employing excessive levels of debt. Those are his high standards. And today, prices are just too high for him to meet those standards very often. And he's okay with that. You can be too." Now, my fifth takeaway was not as much a lesson as I thought a brilliant way of framing the issue of corporate taxes. I'll just let Buffett explain. Begin with an economic reality. Like it or not, the US government owns an interest in Berkshire's earnings of a size determined by Congress. In effect, our country's Treasury Department holds a special class of our stock. Call this holding the AA shares that receives large dividends, that is, tax payments, from Berkshire. In 2017, as in many years before, the corporate tax rate was 35%, which meant that the Treasury was doing very well with its AA shares. Indeed, the Treasury's stock, which was paying nothing when we took over in 1965, had evolved into a holding that delivered billions of dollars annually to the federal government. He's using this as a way of explaining why the tax cut from 35% to 21% benefited the A and B shareholders so dramatically in 2018. And of course, that goes the other way as well as taxes increase in the future. I just appreciate the simple way Buffett framed this complicated issue. So those were my 5 biggest takeaways from the letter. Which do you find most helpful? Let us know in the comments. And if I didn't mention your favorite part of the letter, I hope you'll share that too. Now, as I mentioned earlier, there was one big issue I had with what Buffett said. I'll dive into that one for you in the next video, so don't forget to subscribe and click the bell. I'll see you in the next one.